Hey guys, were you counting your profits before you put your stop losses in places yesterday? As the market rallied on the news from the Fed, and all of a sudden, what happened? Whoosh! Whiplash from the bears, squeezing the life out of the rally attempt from yesterday. So how far did we fall? Is there some good news about this market? We'll find out about that here in today's session of On the Radar. We're talking about a couple of swing trade setups, but primarily I'm looking for how do I find clues that the bear market may be over, and how much further do we have to go? Great questions to ask. So let's get on to today's session right now. Okay, starting with the S&P. Here's some of the good news in the S&P. Let me show it to you. Let me go ahead and grab this candlestick right here, this hammer, as we came out of, this was on Monday of this week, this hammer is a bullish reversal signal that's still in effect. Now, what transpired? Price action raced up, waiting for the Fed. The Fed met. The Fed basically announced, and Jerome Powell gave some positive stuff about how he was going to take care of everything, and Powell price actions continued to raise, and where? Right back up to a level of past support resistance, made up of the 20-day moving average, and look to your left, other past highs. And what did it do today? Gap down. Now, we expected some profit taking, but the profit taking just kept on going to the downside. At the same time, we reached down into the midsection of the long wick on the hammer, and price action, or basically the downside slide, stopped. Does that mean we're going to stop? Does that mean that we're going to rally from here? We don't know, but we are facing the kind of market where this type of price action is quite common, where you'll get a big up day followed by a big down day. And, if it's almost like if you buy the low of the, one day, or buy the close and sell the shortly after the open, you can do pretty good. But that's a crappy way to basically do your plan for trading. I'm going to stick with my rules that I have, which are basically the active trend trading rules. And it's done really well for us. And right now it's got us primarily in cash. We got a couple of positions that are open, but the price action took us out. So we're observing the rule. Cash is king. When the market does turn around, we're going to be so ready to buy that we'll be able to jump in and move to the upside. Right now, after hours, we're getting a little bit of a nibbling. So the buyers aren't really back in town yet. So going on, that's the S&P, the NASDAQ. Now, the NASDAQ did not give us a total reversal signal, bullish reversal signal last week. However, we did retest the lows from Monday. The TSI has crossed to the upside. Market forecast started to cross to the upside and then went, nope, not today. And so it dropped us back down. What could happen tomorrow? We could basically just rally on up and through and back towards these areas. The 20-day moving average is providing strong resistance. And on the weekly chart, while the weekly charts aren't they're not complete yet, they'll be completed tomorrow. Right now, we'd be working on a inverted hammer after a downtrend, so we can consider that a bullish reversal signal after the close tomorrow. What else are we looking at on a weekly chart? Well, we're getting some positive divergence on the TSI. Those are all positive. We're definitely due for a rally attempt. Now, how much of a rally attempt would that be? Great question. We have let me just throw in a trend line right here. We got that trend line. It's got to get back through to break out. And so just be watching that. Again, the selling volume today, much greater than the buying volume was yesterday. The Russell, IWM, similar type situation. Also, no bullish reversal signal. We're right up to the 20-day moving average, stopped and sold off today. This gap down, and this was a kind of a classic bear trap type of move where some buyers would be looking for a pullback into the midsection of yesterday's candlestick at the 8-day moving average because we broke above it and closed above it. And so if that was your trigger to get into a trade and a pullback to that level, as soon as it breaks out this lower level of this support area or the close today, it was time to say, you know what, I'm out of here, and we'll wait for a better signal. We'll wait for a better signal. But the big clue was what was going on is we did not have a bullish reversal candlestick on any of this lower section here. Even though TSI had turned up, market forecast had turned up. And so that's what we're looking at with the Russell. Now I want to jump into take a look at a couple of things. So what to look for when, searching for reversal clues in a bear market. A couple of things we'll be working at is one, percentage of stocks above their 20-day moving average. We're going to take a really quick look at that here in a second. And oftentimes in a bear market, when the percentage of stocks below or above the 20-day moving average gets below 30 or below 20, it's indicative that there is at least a rally attempt in the foreseeable future that may be taking place. That's one of the things we do work for. Number two, the VIX, the S&P's volatility index, when it gets up to its past highs, that is also can be a indicator to be ready for. Not so much I don't trade these two indicators as much as it helps me start looking for reversal signals, and then when I get the reversal signal, then I can move into a position. Number three, extreme oversold conditions on strong growth stocks, and stocks holding above their 50-day moving average. That's a really good way to do it. If a stock even a strong stock is below its 50-day moving average and just rattling the cages, there's a good likelihood that it's had some damage done to it, and it may take a while to work its way back out of the doldrums. Remember, 70% of stocks will follow the trend of the general market. Right now, the general market has a pretty significant downtrend. So guess what? The majority of the stocks are going to go in that same direction. So next time we'll take a look at how to practice trading every weekend. And as close to the live trading as I've ever seen. And I want to show that with you and share that with you because it's a great way to practice. And so let's go ahead and look at a couple of other items. One is, first I'll start here. And here's what the Investor Business Daily had to say. Stocks dive on bond yields soar as bond yields soar in delayed Fed reaction. In my 30 years of experience in the markets and watching several, recession and bear markets that have come along going back since 1991 timeframe, this delayed reaction to the Fed seems to be very common when we're in a weak market. The market will take the information from the Fed and it'll either react immediately with a big sell-off, a very volatile sell-off, or a rally like we had yesterday. And then after the institutions and their analysts chew on what happened with the Fed meeting and the Fed minutes, then they come out the next day and say, maybe we shouldn't have been buying the way we were yesterday. And so they immediately start cutting their positions and pow. So that's very common. Next, let's take a look also at, let me get my slides. And I'm going to go over here to, I'm going to look at a couple of things here. I'm going to bring up this percentage of stocks research. There we go. Percentage of stocks above their 20-day moving average. As you can see here, as I said, when it gets down below 30, that's when I want to start paying attention. Does it mean it's going to be an absolute 100% successful turnaround and rally attempt and rally from there and we go into a new uptrend? Not necessarily. It also, when we get below 20, it tends to give us a little bit more powerful reversals. And like this past week, the reversal was great and the rally attempt was great. It just didn't last long. So another thing you can be doing is if you did nibble a little bit, rather than going for a full 10 or 15% profit on that first initial nibble, go for 7% or even 5%. And it's better to get a bunch of, little base hit, 5%, 7% base hits, and at least you are continuing to grow your account. But if you woke up or went, watched the market go up yesterday dramatically and woke up this morning and all of a sudden the market is selling off and didn't have your stop losses in position, you probably got your face ripped off, and unfortunately all those great profits went the other way. Another thing we can be looking at as we look into individual entities is you want to know which of the indexes, the sectors are doing well. And let me plug that so it'll stay in place. And these are the 16 sectors that I follow, the sector ETFs that I follow, along with the 4 index ETFs. And what I do is I just want to take a look and run through these to see which one's doing the best. Okay, like here is the utilities. How does it look? And I've got a weekly chart on the left here, a daily chart on the right. Daily chart, we've been in a nice little downtrend. Now this doesn't, but on a weekly chart, it's been pulling back into the moving averages and going up, pulling back into moving averages and going up. So we want to pay attention to that, but you can go down through these. And like this is utilities. The next one is the biotechs. As you can see, biotech, it's almost on a round trip to this position here. Is it in a zone where it could rally from? You betcha. The other thing I want to take a look at in a situation like this is what is the monthly charts telling us? And on a monthly chart, as you can see, going back to 2012, XBI has been actually heading up. We're still in a longer term uptrend, but we may become, this is almost a full reversal back into this reversal zone. So if XBI drops into this level, be watching for your reversal. It hasn't happened yet. Doesn't necessarily mean it's going to get to the bottom, but be aware for a reversal signal on the monthly charts. That's another thing to look at. The other one, let's see. XLF is one of the ones I definitely follow, which is the financials. XOP, which is down here. And this is the oil exploration. And we talked about X, and then XLE, which is also energy. But it like I said, what you want to be looking for as you run through this, it doesn't take long to run through 16 sector ETFs. Which ones are trending up, which ones are trending down, which ones are rolling over, and it helps you get a better feel for sector rotation. And as I was saying, XBI may be getting itself set up to move in the other direction. If you're ever wondering, well, what makes up the individual stocks within these ETFs? Great time. You can run over here too. Again, bar chart. I love using bar chart. Go over to bar chart, and this is the bar chart ETFs fund quotes. And in this particular case, this is for the spiders. You just put in the symbol, and then it'll spit out exactly what the makeup of the spiders are, how much Apple they own, how much Microsoft. And as you can look, the Apple, Microsoft, Amazon, Tesla, those make a Google, NVDA, Berkshire Hathaway, the first top 10 or so, down through about Johnson & Johnson, United Health. That'll tell you what's in it. Now, then you can jump over and say, well, what's in the NASDAQ? In the Qs? Well, guess what? They look a little bit alike on the top, and perhaps that's why they and they're weighted. Remember, the Apple is the heaviest weighted. I think it is the heaviest weighted in both of them. That's kind of interesting if it is, because Apple really doesn't have a really good. Yeah, it is top of both one. And right now, Apple's chart sucks. Anyway, sorry for that. That's a trading term for it doesn't look very good. And then you can also go in and let's see what goes into the Russell IWM. And here's why I kind of like the Russell as an indicator of economic aspect of it, is because it is basically a non-weighted index. As you can see, everything has about the same value on it, and it covers a lot more of the economy. And then last but not least, let's say you also want to be aware of what is in XBI, the biotechs. It'll spit out and tell you exactly what is in XBI. And again, it's a really good indication of, okay, here's what's under the hood. And it'll cover, and it's a bunch of different stocks, a whole bunch of them. So, hey, if just as a reminder, if you have not received and checked out, FINRA is trying to potentially take away the potential of taking away the freedom to trade ETFs and leverage ETFs. I'll post a link in the comments where you can go and make comments to FINRA and tell them what a bad idea that is that just let us trade what we want to trade type of situation. I'll put that in the comments. And other than that, that's about it for today, guys. I hope you found that beneficial and helpful. And so until later, let me get back into let me find out where I'm at. Here I am. So as you can see, the markets are definitely weak, and we'll see if they continue to be that way. And so we will have our trade your way to wealth Zoom meeting tomorrow at 11 o'clock Pacific time. And myself, Steve Ferreira, and Anil Parikh will be covering 3 stocks or more. And we'll also be taking another look at the markets to see what the heck's going on. Are we going to continue to slide away? I'm still waiting for the answer to, and it'll take time. Are we looking at a bear market as like 2007, or are we looking at a bear market that's like 2020? I'm thinking 2007 is, or it could be somewhere in between. I'm thinking that right now the path of least resistance is down. And so we've had no capitulation yet, although we may be building towards a capitulation, and we could get multiple capitulations where we drive it down, bounce up on a tradable rally, but we want to be ready to exit that with, when that happens, if it's appropriate. So until later, aloha and God bless everybody.